All right, we'll get underway here. So welcome everyone, and thank you for making some time within your busy lives for the Sedoric Group 2021 Annual Outlook. The slide deck and themes we're about to discuss can be found within our website at www.thesedoricgroup.com. And please do not hesitate to call or email us with any questions you may have stemming from today's presentation. So as we get underway here, the outline today, Tom and I are going to look back on 2020 and provide some important context for why 2020 shaped up to be a rewarding year in markets despite a bifurcated economic recovery. We're also going to look ahead and discuss some important themes as we think about 2021 and the years beyond. And then lastly, we'll provide some actionable planning and investment related ideas so that when we discuss some of these in the coming months and years, they aren't a surprise. So with that, we will get started here. And as we look back on 2020, the obvious subject matter was COVID. But what's less well known or understood is how the Fed and central banks intervened with historical efforts. The Fed dropping interest rates to near zero or to zero, immediately and with a pledge to hold them low for as long as necessary. And then separate, but in conjunction, central banks expanded their balance sheet to the tune of $8 trillion very quickly. And so through these historical efforts, for better or for worse, by April of 2020, markets were able to look beyond the oncoming economic carnage and really began pricing in the economic recovery, but a very different looking economy than the one left behind in February. So for most investors, this is what makes markets so frustrating, is that markets look ahead by 12 to 18 months and we live in the present, and there's a pretty significant disconnect here.
And I think another thing to note, friends, is that the $8 trillion is just the U.S. Federal Reserve Central Bank. Globally, the number is closer to $19.5 trillion of additional debt that was taken on by central banks around the planet. That's a huge, huge number and huge stimulus in the financial market.
Yeah, so a lot of debt out there. And what that translated to was one of the sharpest declines in history, followed by the fastest recovery in history. So what you can see here on this chart is that within 22 trading days, the S&P 500 fell almost 34%, but it snapped back so quickly. It only took all of 4 months for it to be back to par. You compare that with the financial crisis that took 47 months, and you think about the tech bubble of 2000 to 2002 that took about 62 months. So the recovery was sharp, but as you'll see here in a second, it was a little uneven.
And a little reminder, most of you on this call or watching this webinar have lived through the other two significant declines in the market, and you're all better for sticking it out with us. And it was certainly the case this year. Yeah.
So when we think about that recovery, though, like we just said, it was relatively uneven, at least through, I'll call it October or November of 2020. So what you see here is a concentration of companies. So really, these top 5 names made up at one point almost 25% of the S&P. And it was really technology in these big names that brought the rest of the index positive, while the vast majority of the companies within the index itself were still sharply negative. And about October, November, some of the other sectors that make up the S&P started to recover. And by year end, it was more of a broad recovery, but still, at the end of the year, about 50% of S&P 500 companies were still down 10% from their 52-week high. So big concentration in tech, a lot of other sectors lacking.
And you might remember from our earlier calls, webinars, et cetera, we've talked about market breadth, which is really a sense of how many of the boats are rising with the rising tide. And as Casey just said, up until recently, it had not been very broad. And that is not typically the sign of a particularly healthy market. It seems to be getting healthier as things go forward. and we certainly hope that trend continues.
Yeah, and the real story, though, of 2020 was what happened in the bond market. And what you can see here in this chart on the left is the history of the 10-year Treasury yield dating back to 1965. And the 10-year Treasury yield peaked in 1981, and then really since then, it's been a pretty consistent downward trend. That is until you get to March of 2020, where you can see the 10-year yield fell off a cliff and ended up at historical lows. And when you see this sort of sharp decline in fixed income, what happens is that bond values rally. And so you have these really generous stock market-like returns in some of the most conservative areas of the marketplace. Happened in 2019 to a certain extent, and then it's almost like 2020 was just nail in the coffin. So interest rates are now incredibly low. Returns within some of the most conservative areas have been abnormally high, and this is a trend that just won't continue.
Casey mentioned the fact that bond prices and yields move inversely, and we need to be reminded of that repeatedly when we talk about the bond market. For the bond market to turn in any kind of return like it did in recent years, interest rates would have to go negative. Now, they are negative in certain parts of the world, modestly so. They could become negative here. Essentially, what that becomes is a non-legislated tax on your wealth. We hope it doesn't happen, but it could, and that would be very positive for the bond market as well. But don't count on it happening, folks.
So banner year in fixed income, as we just said, uneven equity market recovery, but by the end of the year, a lot of areas of the market had sort of at least caught up. And what you'll see here is this is one of those quilt charts that many of you may have seen at some point. But what you'll see here within the 2020 column is you can see small caps and emerging markets ended up leading the way, but it wasn't until October, November where they became attractive. Emerging market equities were really lagging throughout much of the year. And overall, pretty decent year in markets. So.
And this is, many of you have seen this quilt chart before. We've used it for years. It's a stark reminder why timing the market doesn't work. You need to have broadly diversified asset portfolios. And we do. We will maintain those forever because nobody can guess what's going to be the best performing asset class year after year.
So when you add all this up, fixed income had a heck of a year. Equity markets in general recovered and generated some pretty sizable returns. And that brings us really back to where we started the year 2020. And we say it like that because if you recall, during our January update in 2020, we spoke to needing to be cautious about the months and years ahead. Interest rates were low, equity valuations were rich, and there was a pretty high probability of some sort of downturn in the future. And ironically, interest rates are lower now than they were a year ago. U.S. equity valuations are more expensive now than they were a year ago. And so we're back where we started. The probability of a downturn remains elevated.
And we're prepared for that. You have been prepared. You've weathered the last 2 storms, last 3 storms, last 4 storms. You weather this one just fine as well.
So that's a quick recap of 2020. And now we start thinking about the future and really looking ahead. And I think the title here says it all, which is the future is now, but lower returns are still likely. So as an investor, we're pretty excited about the next 10 years. When we think about COVID, COVID really acted as an accelerator to a lot of underlying trends that were already at play. And so when we think about the work from home movement, we think about telemedicine. And these were 2 major trends that were already in play, but were apt to take place or play out over maybe a 6, 7, or 10-year timeline and do so more naturally. Instead, we were all shocked into disruption and we've all been forced to adapt. But when you think about the rate of change and all that is now still to come, we think about AI, we think about smart cities, we think about the disruption that's after current education, healthcare. There's a lot of opportunity out there, but it still doesn't, I guess, dismiss or mitigate all of the other challenges that we have. But when we think about equities, we think about opportunities. We're pretty excited about the next 10 years.
Some of you will remember a chart we used. I think it was in our March. No, I'm sorry. It was the August webinar that we put on, where we showed a graph of a number of companies being formed in the middle of a recession. Companies like Tesla, companies like Microsoft, McDonald's after World War II. There are companies being formed right now in the middle of this recession or economic contraction that will be leaders 20 years from now. We have to be reminded of what was called the Nifty 50 back in the 60s and 70s. Those are the companies you absolutely had to own. Many of them don't even exist today.
Good point. So another major theme as we think about the next 10 years, and this is a kind of a repetitive theme, is this dilemma of low interest rates. And so again, here's another chart that shows this downward trend when it comes to interest rates, which means that for the better part of all of our investment lives, fixed income bonds have generated closer to stock market-like returns. So this downward trend has been a blessing for everyone. When we think about the years ahead, whether interest rates remain low or whether they trend upwards, no matter what, the returns of yesterday are unlikely to be repeated in the years ahead. So this is a major, major dilemma for all investors of all shapes and sizes, and ultimately translates to bringing everyone's rate of return down some.
And many of you have heard us use the term, we are compensated to look around corners for you. I would ask anybody watching this or listening to this webinar, think about what the first and second derivative issues are with low interest rates. Think about the implications for the insurance industry, the banking sector, our pension funds, you name it. And we're only in the early innings of this really ultra low interest rate environment. So how it all plays out, it bears a lot of questioning, and we encourage you to kind of ponder what it might mean for you and some of the institutions that you've used in the past.
Yeah, and when we try to personalize this message of low interest rates and how it may play out within portfolios and how do we plan for this future, which we already have been, this chart here gives you a sense of how dramatic, or I guess the implications and how dramatic those implications are. So this chart here along the bottom, you can see 0, 2, 4, 6%. These are projected nominal returns over a 10-year timeline. And up here on the left-hand side, you can see various categories of fixed income, bond strategies or positions. And what the common theme is here is that all of them, except for one, are priced to deliver sub 2% nominal returns. That is not a good thing when you think about wanting to maintain a conservative allocation, or it's especially not a good thing when you think or try to compare it to what people are used to over the last 40 years. And people are used to that 4 to 7% return, not a sub 2%. So when we think about fixed income and bonds moving forward, they're really meant to serve more of their traditional role of offsetting equity volatility rather than producing those stock market-like returns.
And we use terms like nominal and real interchangeably in our profession. We probably should define what nominal means. That means the actual yield. So what real returns mean net of inflation. So if you have 2% inflation and your bonds have a 2% nominal return, it means you're not making any money net of inflation. That's zero real return.
Yeah, so this is a real challenge here for everyone. And to Tom's point earlier, think about banks, insurance companies, pensions, endowments. The whole world is grappling with this dilemma. So when grappling with this dilemma, naturally investors say, okay, well, what about the equity markets if the fixed income markets are apt to underperform? And when you look over at the equity markets, no matter how you slice it, the US is incredibly expensive. And so what you can see in this chart here is this middle line across the top in the upper chart is meant to represent sort of an average valuation when you look at the world. What you can see here, here's the US, and this vertical rectangle is meant to represent the US's own, call it historical average, and then this horizontal bar is the average of the US. Now, like Blue Diamond is where we currently are. So the US is incredibly expensive relative to its own past, and then when you compare it to the rest of the world, it's even more expensive. And not to get too technical here, but we're talking about a 5 standard deviation event here. The financial crisis was more on par with like a 3 standard deviation event. So valuations here are incredibly expensive. That does not mean, though, that they're apt to turn around tomorrow. We're not calling for a market correction next month. We're just saying that expectations have to be scaled back because you're not going to get the next 10 years of returns are not going to resemble the last 10. And the last point here is, if you look here at the bottom, the emerging market countries, is a lot of these emerging market countries are cheap relative to their own histories and cheap relative to the rest of the world. So foreign markets are relatively attractive. The U.S. market is looking to set records in terms of how expensive it can get.
And as Casey said earlier in this presentation, the market was very narrow, so it's primarily the growth companies that are so expensive. Value stocks, which are the boring utilities and maybe energy companies, they're not grossly overpriced in the United States, but there are better values overseas for sure.
Yeah, so good point, Tom. And that's our next chart here. Same thing as when you look at the fixed income chart, but this chart is now trying to provide us with a projection when it comes to equities. So same thing, nominal returns before inflation across the bottom, 0, 5, 10%, and then traditional asset classes listed here on the left. U.S. markets, relatively expensive, are apt to deliver average to below average returns, especially to Tom's point, when you look at U.S. growth, and these are the go-go stocks of the last 5 years, the brand names, the Facebooks, the Teslas of the world, because of how expensive this category is, it's actually projected to deliver well below average returns when we think about the next 10 years. So the one category that does look attractively priced and may be primed to deliver average to above average returns are those international markets, and especially the emerging markets. So everyone just needs to kind of scale back their expectations. Equities are not going to save us from this one.
Particularly in the United States, it's worth noting, and we've mentioned this before, but I'll mention it again, that any way you look at foreign markets, they're cheaper on a relative basis to the U.S. They're cheaper on price to book ratio, price to earnings ratios. And in many cases, the dividend yields overseas are 2 to 3 times what they are in the United States. So if you're not internationally diverse, you'll probably regret it down the road. We've talked about the lost decade that occurred in the United States between the year 2000 and 2010. So it was the dot-com bubble that popped, then the financial crisis in the middle of it, 08 and 09. So there's basically no return in the S&P 500 from 2000 to 2010. It was called the lost decade here. The foreign markets are coming off a very similar experience where they're coming off their lost decade and are likely to outperform in the future.
Yeah, and then our last major theme as we think about the next 10 years is a change in tax policy. To basically say goodbye to historically low tax rates and make sure you're on your accountant's good side and in good graces with your accountant, because tax policy is apt to change. And it's sort of a misconception that a lot of people sort of not pretend, but believe that tax policy, it changes every so often. And the only constant with tax policy is the evolution of the tax code. We have a new administration in place. We talk about the budget deficits that are piling up, or when you think about state budget woes, taxes are going to change. We've been talking about this for the last couple of years. We are now really on the heels of the Secure Act, and now we're anticipating tax policy change as soon as this year. So a lot more to come here, but if you're not planning for an evolving tax code, when you think about savings, spendings, distribution strategies, estate planning, big mistake. There's a lot of planning to be had and a lot of money to be saved via that planning.
Yeah, I think at the tail end of last year, we had close to 40 or 50 Roth conversions going on. This is because accountants and their clients, with our counsel, were suggesting that clients could get money out of their traditional deferred accounts into Roth accounts for tax-free income or tax-free growth, and many jumped on. And I think you'll continue to see that happen depending on how the tax code evolves under the new administration.
So on that happy note, where yes, we're excited about being an investor, but oh, by the way, interest rates are at historical lows and equities aren't going to make up for our problems. And oh, by the way, tax rates are apt to rise. what are some of the actionable ideas when we think about the years ahead? And the first actionable idea, it's less about what to do and more about what not to do. And it's about not getting caught staring in the rearview mirror. So all too often, we believe the best performers of yesterday are apt to be the best performers of tomorrow. And this chart here is meant to represent or to highlight how market structure changes. And it shows the top 10 companies by decade, and what you can see here is how those names change every decade. On average, about 2 of those top 10 are still in the top 10 years later. And so when we move our way out to the year 2019, we all know these companies. Many of us think highly or poorly of these companies, but it's hard to imagine that these companies aren't going to be the leaders of tomorrow, yet all of history suggests that 8 of them are going to fall out of the top 10. So it's just an important reminder, don't get caught in the past. We have to be thinking about the economy of tomorrow. And the last part here is a great company doesn't always equate to being a great investment. So
you've heard us use a term in the past called confirmation bias. People get stuck looking in the rearview mirror, thinking that's the way to drive. And we strive diligently to help prevent confirmation bias. You can all remember that GE used to be a blue chip. I think it's down probably 80% from its highs, cut its dividend 6 or 7 times. There are countless other companies left by the wayside that used to be great that are no longer. So just be nimble. That's all we ask.
Yeah. And then this brings us to, if we're not getting caught in the past or looking in the rearview mirror, back to the theme of foreign markets may be primed for outperformance. And when we spoke to the uneven recovery until about October, November, and how emerging markets actually leapt to the front of the line, what this chart here shows is the history of how the U.S. and foreign markets have sort of swapped leadership positions. So the purple being the foreign markets, the gray being the U.S., and you can see the cyclicality of markets. And the U.S. has outperformed pretty significantly over the last 12 or 13 years. But back in October of 2020, the U.S. dollar started to soften for the first time in 9 years and really provided somewhat of a tailwind for foreign markets in a way where foreign markets, because they're relatively cheap, to Tom's point earlier, they pay higher dividends on average than their U.S. counterparts, and with a U.S. softening dollar, could bode well for investors when we look ahead. So opportunity here.
Yes, the softening dollar could be a huge, huge tailwind for foreign assets. It acts like an accelerant. Casey used that term earlier, and that's what it does. So don't abandon your foreign markets, even though they haven't done much for you in the last couple of years.
This also, when we think about opportunities, actionable items and opportunities in the years ahead, the concept of ESG is a big one. So ESG is meant to represent environmental, social, and governance. This is really representing the ability for investors to better align their investment portfolios with their values. And by means of ESG, companies are really beginning to integrate ESG themes into their business plans and corporate mission statements. Now, basically, companies are beginning to incorporate things like inequality or diversity, climate change, energy efficiency into their bottom line in a way that's apt to disrupt the otherwise incessant march towards maximizing shareholder value. And this is a big deal in rebuilding the corporate social contract that's been in decline for some time now, and it really also has the ability to influence market cap and valuations of various companies as investors, kind of personalize their portfolios in ways that they haven't been able to before. And we believe that over time, corporations, or I guess the corporations of tomorrow, are going to have to align with a value or a cause, and one that's apt to benefit society and not just by means of their product or service. So this is I don't even want to call it a trend. It is a big deal, and it is apt to influence and shape markets, and that is apt to translate to returns when we think about the years ahead.
Yeah, I agree with Casey wholeheartedly. This is not a flash in the pan, feel good kind of event. One of the biggest institutional managers in the world, BlackRock, over was a year and a half ago, Casey, 2 years ago, the CEO, Larry Fink, wrote a letter to all, and they're often the biggest shareholder in any one company because they're so huge. And he wrote a letter to the CEOs of all the companies they own saying that they needed to clean up their act in all three of these areas, or they would dispense with owning the stock.
Yeah, so this is a very big deal. And it's also, I think a misconception has been if you wanted to align your portfolio with your values, that you were apt to give up returns in some way. And, really, that is a misconception. And in some ways, when you think about the valuation of various companies, these ESG, call it filters, or concepts may be actually inclined or may be apt to improve performance long term because of their ability or intent on focusing on the future rather than just the present. So investors have not been sacrificing returns of recent.
You'll find that ESG firms tend to look longer term than companies that are looking quarter to quarter, and we think that's a good thing as long-term investors.
So we think there's a big opportunity there when we think about the next 10 years. And then lastly, back to tax policy, there are a lot of opportunities as tax policies evolve. In this statement in the upper left-hand corner, we want everybody to be saying this out loud with us. A rate of return is only as good as its net return after paying taxes. We want that implanted in everyone's brains as we think about the next 5, 10, 15, 20 years and beyond. Because with proposed tax policy changes comes opportunities for us to plan accordingly, whether it be an accumulator, someone that's in the midst of their savings years, whether it be somebody that's retired in the midst of their distribution years, or even as we think about estate planning and the generational transfer of wealth from one generation to the other. So here's just a quick list of some of the proposed tax policy changes of recent. We're not going to go through these in detail right now, but do want to highlight just two of them, call it low-hanging fruit. The first one is that, yes, it's likely that the top tier tax bracket reverts back from 37% to 39, almost 40% for incomes of 400,000 or more. What kind of actionable items? What might we want to do if that's the case? Well, for some, it may be taking gains or front-loading some income. Like Tom mentioned, maybe some Roth conversions when we think about low earnings years versus higher earnings years. And then there's also qualified charitable distributions that make for great opportunities in terms of your charitable giving, as well as offsetting some of your income tax burden. The other proposed change that we want to highlight here is the likelihood that long-term capital gains tax rates evolve over time. They've been historically low, and actually that's a good point to comment or to point out that the tax environment we are in today is incredibly advantageous relative to all of history. It's hard to appreciate it because nobody likes paying taxes, but if you had to pay taxes, now is a pretty good time to do so. So when we think about long-term capital gains rates, it's apt that those tax rates change over time. Some of the actionable items here and things that we executed over the course of the last 12 months. Tax loss harvesting, really important. Selling something when it's down, buying something similar through a swap to participate in the upward recovery, but you have now also realized losses to help offset future gains. And then the other concept is asset location. And in its most simple, summary is you want to try to hold your most volatile and growth strategies in your post-tax accounts. You want to try to hold your income producers and more conservative strategies in your IRAs. And your Roth has sort of this hybrid approach of growth and income. But by means of saving correctly or properly, and then aligning those investment strategies accordingly, we're prepared for the evolution of long-term capital gains rates.
And there's one thing that's a constant is death and taxes. So don't think for a minute the tax policy isn't going to change, and be nimble and be prepared, and we are.
So as Tom likes to say, taxes are your life's greatest expense. Your accountant should be one of your close friends, and we are ready for what lies ahead. So that brings us to the conclusion of our 2021 annual update or outlook. We want to thank you very much for spending some time with us. We know your lives are busy, and we're incredibly appreciative for the trust that you place in our team as we navigate the years ahead. So thank you very much.
And naturally, if you have any follow-up questions, we welcome them either by email or pick up the phone. We're happy to speak with you about anything. Thank you again.
Thanks.
You stopped. We're still recording.